Hello, everyone. My name is Curtis Eatman, and one of the number one questions I get asked is, how do I build a family legacy plan? And today we're going to be talking about how to remove the liability out of your legacy. So I'm excited about this conversation with you. So one of the biggest things when you start really breaking down a family legacy plan is understanding the difference between assets and liabilities, right? So the real question for you would be, what is an asset to you? So let's define it. Well, assets put money in your pocket, liabilities take money out of your pocket. So if you have a goal right now to say, you know what, I want our last name to hold some weight because I want a family legacy plan to be able to skip generations, you don't want any liabilities to be able to be a thief of that legacy plan, right? So let's kind of really break it down, because at the end of the day, we only put insurance on things that we feel are assets. So for example, maybe you have some memorabilia, right? Maybe you see behind me, I have a Mike Tyson glove. My wife got that for me a while back, and it's signed by him. And I was like, wow, that's a great memorabilia. So I put insurance on that. Why? Because that's something that is an asset to me. Maybe you have, maybe a baseball card, or maybe you have some valuable shoes from an athlete or celebrity, whatever that may be. And that's something that's valuable to you. You want to put insurance on that. Maybe you proposed. Maybe you have a spouse, and either you're the one that offered the ring or the one that received that ring. Regardless of whatever one that is, that ring is sentimental value to you. But most importantly, that was expensive to you as well. So you would put insurance on that, right? Maybe you bought another asset like a house, right? Maybe an investment property. Well, I promise you're going to put insurance on that. Why? Because if anything is damaged, you're going to want those things replaced. So at the end of the day, if you have an asset, all right, what you're going to do is you're going to want to put insurance on that to either replace that if something ever happens, gets stolen, gets damaged, or if it's priceless to you. Okay, so again, we only put insurance on things that we feel are assets. So when you really start breaking down, the real question at hand is going to say, how can you guarantee your legacy has asset value? Because now we understand what an asset is, but really the question is, what type of value does it have behind that asset? How can we define that value? So let's kind of break it down. One of the biggest things that you really want if you want a family legacy plan is to have a living trust. So let's define it so we're all on the same page. A living trust is a legal arrangement that lets you decide how your assets are managed and distributed, both during your lifetime and after you die. So a living trust owns, again, the property that you put into it. So that could be that memorabilia, it could be that ring, it could be that house, it could be any other asset you see due to be able to go into that trust, while often still letting you control the trust as assets. Okay, so everybody needs a living trust. So the real question is, do you want more or less value in your trust then? Because your trust is the one that actually holds all those assets. Well, if you're anything like me and you're on this, again, watching this video, I'm assuming that you want more. So the real question is, why would you use maybe insurance to help increase your asset value? So let me give you some pros, okay? So maybe you know this gentleman is, right? And his name is Rockefeller, right? Maybe you heard of that name before. Well, what he created was a family tree. Okay, so in his family tree, he went to all his family members and he says, hey, I'm about to build an empire. Would you like to be part of this family tree? Some people opted in, some people opted out. And those that opted in still have access to a trust fund that has hundreds of millions of dollars in it to this day, all right? Maybe you're familiar with this guy. Maybe you go to Walmart sometime, right? And his name is Sam Walton. Well, he did the same exact thing. He created a family tree, and those that were a part of that family tree are still able to benefit from those funds and whatever else is in there as well. How about, this gentleman, which his name is JF Kennedy, right? I have a cup behind me that says, one person can make a difference and everyone should try, okay? And he created a family tree as well. And we still know about his family to this day because of how powerful their trust fund is and the access that a lot of those members do have to this day. Maybe you know who Howard Hughes is. He did the same exact thing. So what's my point? There is a proof in the concept of using insurance connected to your trust fund. Okay, so what a lot of people are doing today, especially these gentlemen that set up these family trees with their family, is they made sure that anyone that wanted access to that trust, they all had to have an insurance policy. So proof again is in the concept. Let's use understanding, let's kind of talk about it really quickly, why it's so important to use insurance if you're not using it currently right now to be able to add value to your trust fund or to your family legacy plan. At the end of the day, if you go decide to build real estate, okay, and you want to go build different properties, you want to build an empire. You start buying one, and then you flip and you buy two, and you end up buying 10, and you have multiple around the country. You had to build that before you can pass that to your next generation. Let's say you want to build a business. Maybe you're an entrepreneur. Maybe you're a C-suite executive. You're building something right now, and you're building your cash. You're building all these different assets. Well, you had to, again, the key concept of what I'm bringing up is you had to what? Build it before you could pass it down to the next generation. Well, when it comes to insurance, it's a big wealth hack because you're able to pay pennies today to get a dollar. So I'll say this one more time. You're paying a penny to get a dollar, right? Which means you're able to get that dollar without having to build the dollar before you can pass that on tax-free to the next generation. And this is not hypothetical. This is not potential. This is not projected. This is guaranteed. So there's actually one of the only concepts that you can actually pretty much use that is guaranteed, where you don't have to literally build it to be able to guarantee it's going to go to the next generation tax-free. So why would you not have more insurance if you're able to, again, skip the building process in essence, right? So when you start thinking about the cons, so you say, okay, Curtis, well, I understand the pros of using insurance. What's the cons if I don't use it? Well, let me talk about some families that didn't use it and actually built wealth too. So maybe you're familiar with that family I just showed on the screen. Well, let me tell you who that family was. It's the Vanderbilt family. So let's kind of talk about the Vanderbilt family. It's one of America's wealthiest families in the 19th century due to their railroad and shipping empires. The Vanderbilt fortune dwindled over generations due to extravagant spending and lack of proper estate planning that would have preserved their wealth for future generations. And kind of crazy enough is that the Vanderbilt family actually had more money than the Rockefeller family. But we don't talk about the Vanderbilt family today, only for cases such as this saying, dang, wow, they dwindled all their wealth. The reason why is because they didn't have the right estate planning. They did not connect insurance again to their trust fund. So therefore, unfortunately, they don't have any money today in regards to that. Let's keep going to the next family. McClure family, maybe heard of this family before. And as reported in historical accounts, the McClure family, who made their fortune during the California gold rush, saw their wealth dissipate over generations due to poor management and failure to adapt to changing economic conditions. Right now, there's a lot of different economic conditions changing. What's happening? You have Saudi Arabia did not renew the contract when it comes to oil, when it comes to the dollar. You have digital currency now appearing. You have a lot of different things with inflation, right? You have BRICS, which a lot of different countries are now coming together to create their own currency. I could keep going on and on. Taxes are not going down, they're going up. Economic conditions are changing consistently, and those that are not adapting and don't connect a guarantee to the assets that they're building, unfortunately, may see their wealth or future wealth dwindle as well. We can learn from McClure family. Another one is Hemingway family. While not bankrupt, the Hemingway family's experiences show how mental health issues and personal misfortunes can impact family wealth. I think it was reported just recently that 1 out of 4 people have a mental illness, right? That's a big problem. Why? So when you start breaking down those that are in a family and you have access to wealth and you're not mentally in the right place to make right proper decisions financially, that one decision can unfortunately mess everything when it comes to the family's legacy plan. So you can see right here, Ernest Hemingway himself had not made extensive estate planning arrangements, which led to complications after his death. Can you imagine building, like you've been working consistently, saying, I'm going to make sure my family legacy plan is literally legit. And then unfortunately, the next generation messes it up because they just didn't understand the proper estate planning, or the one that did build it didn't understand it as well. So what's my point? Everyone could be intelligent. You're getting information right now, which means you're receiving it so you can hopefully act on it. And that's great. But being wise is learning from other people's mistakes so we don't have to walk through the same alley, unfortunately, or the same pitfalls. So the real question, as you are considering building your own personal family legacy plan and building that family tree effectively, and you'll be able to offer different branches that are going to offer shade to those generations in the future, how much are you currently worth right now? How do we increase the asset value? Are you worth $1 million? Are you worth $5 million? Are you worth $10 million? Are you worth $20 million or more? And most people will say, well, my mom said, I'm priceless, right? Well, we can't put a number to the priceless mark on that. So let's kind of figure out the definition, or the benchmark, I guess you would say, to kind of figure out the value of what your asset really can be in your trust. So the real definition, you could probably see on the screen, or the benchmark to the value of you is how much insurance can you get approved for. So for example, can you go into an insurance company right now and say, hey, I would like to be insured for $50 million? Would they say yes, or would they deny that claim? The real opportunity for that is if they did approve you for $50 million, all right, so now you have a life insurance policy for $50 million, your asset now value automatically increased $50 million. So think about that again. You didn't go and build $50 million empire, okay? You don't have a bunch of real estate that's worth $50 million memorabilia. You only went to an insurance carrier and said, hey, can I get insurance for $50 million? And they said yes. And if they said yes, now your trust now owns that insurance policy, which means your trust now is worth what? $50 million. Now the real question is, would they approve you? And why would they not? Because their job is to what? Make sure that they can pay that out into your trust if something ever happens to you. So how much could you get approved for? Can you get approved for $1 million? Can you get approved for $2 million? Can you get approved for $5 million? So this is the concept of why would you have less insurance when you can have the most? Because the more insurance that you do have, you've been paying pennies for what? Dollars, and your trust fund automatically has increased in value. It's the easiest, most wealth hack way to increase the asset value of your trust and your family legacy plan. So as we go to more concepts as well, how else can you build more value? Because maybe you're not getting approved for $50 million right now. How can you one day get approved for $20 million or more? Well, that means you have to increase your income, because no insurance carrier is going to be able to insure someone without seeing value behind that insurance, right? So there's different ways you could do it. You could do it by being self-employed, okay? Which means that you're in the position where you're more on a profitable standpoint, which means your income is created from you actively going and creating that. It's production focused. Maybe you're business focused, where you say, I have operated a business. Maybe you're a C Corp, you're S Corp, maybe you're LLC, and you're operating a business, and you're more creating more passive income because you have systems, you have employees, you have 1099 freelancers all in your business as well. And it's more distribution focused. Maybe you're asset focused, right? Where you're purchasing different assets, and you also have leaders that manage those assets as well. So but therefore what happens is, because you have leadership development focus, people usually want to buy those assets from you, and you're able to increase it by 10 to 20 multiples. There's multiple ways to be able to increase, again, your asset value. But the whole key is to what? To increase the income so that you're worth more. So therefore you can get more insurance to speed up the value of your trust fund, right? So let's keep going. Here's a Rockefeller waterfall method, right? Maybe you heard of it before. There's actually 6 steps. And again, being wise is following steps. You don't have to recreate the wheel. They've already have a great plan, right, that most people follow, and those that do follow it are having, again, their family legacy plan in place the proper way. So let's talk about it. The first thing you need to do is set up a trust fund. Now, there's multiple different trust funds, all right? A lot of people don't know about all the different trust funds, and most people say, well, I have a trust. Just because you have a trust doesn't mean it's the right one. Not all trusts are created equal. There's charitable remainder trust, there's asset protection trust, there's ABC trust, there's pour over trust, there's revocable trust, irrevocable trust. There's so many different Swift trust. There's a lot of different types of trust, and it has to be a great fit for, again, what you want to accomplish for your family legacy plan. So are you working with an estate attorney that knows exactly what they're doing so they can give you the guidance that's properly needed to make sure, again, you're accomplishing what you want for your own family legacy? So the number one thing is set up a trust. All right. Number 2 thing is saying get approved for a properly structured, I'll say this again, properly structured and engineered cash value life insurance policy. Why? Because you need all the members of the family to be able to have that policy. That's exactly what the Rockefeller family did. He says, you want access to this trust? Everybody has to have an insurance policy. All right. Number 3, make the beneficiaries of those policies the trust. Okay. Number 4, members of the family can take loans, because loans are tax-free, all right? Loans from the policy to start other businesses, buy other real estate properties, other assets, invest, etc. Whatever you like to do, you now have the money and you raise the capital to be able to do it. Because why are you using your own equity? Why are you using your own money when you can use other people's money? Instead of using other people's money, use insurance carriers' money. You got billions of it just sitting around looking for, again, a partner to be able to make their money move with, all right? That's an opportunity. And number 5, when a member passes, okay, the death benefit of that policy will pay the trust tax-free. And number 6, moving forward, the family's wealth will transfer on for generations. Now you have a family banking system that perpetually is going to be able to be created with new tax-free money consistently, right? So this is another way to be able to position yourself to be a Bank of America, a Chase, a credit union, because those are all just trusts at the end of the day. And how do they raise money? They raise money by having what? You have a checking account, a savings account, a CD, right? That's how banks be able to create money. At the end of the day, they're a trust. You can do the same exact thing, right? But this is a great system that has obviously worked very, very well that you can also be able to use as well for your own family legacy plan. So what are you truly building? Let's kind of recap what we talked about again. So what are you to your legacy? Are you an asset to your legacy right now? Okay. The legacy plan you're building for your family, or are you a liability which is taken away from it? Right? So hopefully you're in a position right now where you're actually increasing the asset value of that trust, of that family branch, right? Of that family legacy plan you guys are creating for them. So when you start thinking about the two most dangerous things you can possibly do, number one, you can fight with someone that has nothing to live for. That could be a very big issue, right? And number two, following someone who doesn't know the destination. Okay, those are the two most dangerous things you can possibly do. And I see, again, family legacy plans destroyed, and they become liabilities consistently because of those two different things, right? So if you slow down, I can't tell you how many people I meet with, they're highly successful, and they say, you know what, I made my money, I'm pretty comfortable, I'm pretty content. And there's nothing wrong with being content. There's nothing wrong with that. You might have built your success at this moment, and that's great. But if you slow down, that's more on we call it a selfish side of things. Why? Because there's still more people, right, that need help in your lineage, right? So if your money that you're creating today is only able to help you, it's not able to help multiple generations. We say your money should be able to help 2 generations down on minimum. But the real key to wealth is building 7 generations down. So the dollar you create today, can it skip 7 generations? Okay? Because if you do that, you're more selfless, and you're opening a door for, again, those future lineage of your family legacy. So at the end of the day, what is your finish line that you're building? Okay, so if you're watching this, you're saying, okay, I really want to build my family legacy plan. But really, what is the finish line? What does that even look like? What you'll see here is an oil painting, right? And this is something that a concept that a lot of royal families have always done. They always have a painting of someone that they have high gratitude for, usually in the family. Because at the end of the day, there's always one person in every family that has literally made that family either a family legacy or a family that unfortunately we just don't know about. And one day, hopefully your picture is an oil painting up, and you have your great grandchildren that have you, all right, in the living room, and they look up and say, oh man, I'm so thankful for great grandpa, right? Why? Because, or great grandma. Why? Because they persisted, they were consistent. And I'm so grateful why they built something for us. We have a trust that we have access to be able to have a lifestyle where we can walk truly in our purpose. Because at the end of the day, there's always going to be one, and hopefully it's you watching this as well. So here's an example of a couple different ones that we created in a couple different systems if you're looking for action plan at the end of the day. So one of our concepts is we help people build wealth. We help people protect their wealth. And we make sure that when you set up your wealth and your trust the right way, that your next generation is set up to be better than the rest. So when you start breaking down how you want to really do it, right, on an action side of things, you can do it this way. You have a trust, right, that you need to get created. You need to meet with someone first on that aspect. And each member of that family, all right, has a percentage, all right, of their personal life insurance policy as the trust beneficiary. It could be 25%. Like for ours, we have 25% is the death benefit, goes right into the trust. So if someone in our family tree, okay, has $1 million policy, for example, okay, 25% of that, which will be $250,000, would go automatically to the trust fund if the member passes away, and that's tax-free money. 75% of that money, as you can see, it goes to either their immediate family or a charity of their choice, okay? So that's usually how that's set up, right? You can set it up however the percentages you want that you see fit for how you want to create your own trust. Here's some roles that you're going to need to make sure this is accomplished the right way. You're going to need a board of advisors. I always recommend that you have odd numbers. So 3, 5, 7. Why? Because you always need a swing vote. And the board of advisors, their purpose is to make decisions on how the trust is moving forward. Because it's really ran like a company, right? It's really ran like, again, it's an empire. So you need those that have what's the best word to say? The best insight and investment in that family legacy plan to be successful. And so you want the three most, again, understanding individuals, right, to be able to sure that they're making the right decisions when it comes to, again, that trust. Next is going to be an executor. That's pretty much like the president, all right? And they have unanimous decision, again, over even the board if they want to. They're basically the CEO, the founder of that trust, and they're going to make decisions based if they don't even like the board's idea of what's going on. Next, you have trustees. Those are the ones that have access to the trust. Then you need an estate attorney that can set up the documents properly, all right, because it kind of spells out how that trust is accessed, how it's not accessed, when can you do things, when you cannot, all that's available. Next, you need is a life agent or a life broker. Okay. And again, not all life agents or brokers are created equal. You need someone that can set up a properly, again, engineered, structured cash value life insurance so it's able to do the things you want to do in this trust. Next is you want a bank relationship because you're going to be able to create a lot of different proceeds and funds and capital, and you're going to be able to hold it somewhere at the same point. So these are different roles that you're going to need to make sure that, again, your family legacy plan is executed the proper way that you want. So again, let's kind of go over a couple different concepts. You have a percentage of that trust holdings that you're going to have for loans, right? Because like the Rockefeller family, all the members, right, of that family tree were able to go and access it for either real estate, for different aspects of what they want for investments, etc. So what you want to do is kind of decide out of that trust how much of that money could be used for investments or be used for loans. Usually you want to from 10 to 20% of that. Next is where is all the money, the capital being held at? What's the trust holdings? What are the different places that you can put in regards to diversification for asset class? So you might put some of the money in high yielding liquid savings. Maybe that's 50%. Maybe you put some of it in life insurance permanent. Okay. Maybe you put some in real estate. Maybe put some in alternative investments like crypto or stocks. Maybe put some in an annuity for guaranteed lifetime income. These are different aspects, again, asset classes that you can diversify, okay, the trust holdings, so you make sure, again, that you have different places that you have access to just for you and the opportunity for the people that are also in that legacy plan too. So, again, what's your exercise? Your exercise, and maybe you're watching the video, you can always rewind it if you missed anything I'm talking about. The exercise is really simple. You want to get a piece of paper and you want to list out your family tree. Okay, like who in the family wants to be part of this trust? Okay, who in the family wants to have the shade and their future, again, lineage to have the shade, again, of this family trust? So who potentially can be in the trust is the first question. And then you want to also look into premium dollars that they can pay monthly, okay, into a policy, because everybody contributes to their own personal policy. Number 3, what is the total death benefit that they currently have? Okay, so you probably already have insurance. If you have insurance, how much insurance do you have? How much are you paying for? All right. And then number 2, what you'll see right here is what do we really need, okay, to get everyone to their next level? Because again, the more insurance that every member has, the higher the value of that trust fund becomes. Okay, so we want everybody to have more insurance. We want to give everybody to the first level, which is $1 million. Then we'll get everybody to 5 million, to 10 million, to 20 million. Why? Because the value of that trust is increasing at a higher rate. So then it goes to the number 4, which is what? How much is your trust now worth? So if you think about it, if anyone already has insurance currently right now, okay, and they are now a member of that trust, okay, how much is that trust worth with all those assets in it? Right? You want to know that number. All right. And for each level that you're able to get to the next member to, how much would that cost? This is when you're going to do some shopping. So when you're going to meet with a life insurance agent or life insurance broker and kind of get some quotes and kind of figure out, okay, if I add more to this member, if we add more to this member, how much will this trust increase in value, but also how much would it cost in premiums to be able to increase that value of that trust? And your next move is really simple. Set up your trust. Okay. Number 2, increase your personal policies. 3, if you have existing policies, amend those beneficiaries so it's connected to the trust. And then you need to spell out the conditions to access to that trust and those that you decide to be on the board. You can do a vote, by the way, for the board advisors. And those that are able to step into those board seats, okay, you need to be very clear, all right, on what the responsibilities are, all right, and what could be the cause of termination of that board seat as well. Okay, so these are different things that you should be looking at. And if you need any help at any time, don't worry about it. We have different aspects we can do to be able to help. From if you need a trust attorney, we have, again, relationship with that. If you need, again, a life insurance agent or broker, we have relationship with that. But all this can definitely be accessible. But there's going to be a QR code that's going to pop on the screen that you're more than welcome to click to be able to get a better understanding, because the only thing we would love to do, if anything, is to add value to your current financial situation. And Forbes reports it right here. We're not a product of our circumstances. We're a product of our decisions. So this whole conversation here today was to help you increase your family legacy plan, at least get the information so you can have the information to make better decisions. And if you execute on that, we're excited for what your family can become. So with that, my name is Curtis Eatman. Thank you so much for being on today's call, this video, and hopefully we hear from you soon. Bye-bye.